Ladies and gentlemen, good day and welcome to the Q4 FY23 earnings conference call of Prudent Corporate Advisory Services Limited, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ansuman Deb from ICICI Securities. Thank you, and over to you, sir.
Thanks, Michelle. Good morning, ladies and gentlemen. On behalf of ICICI Securities, we welcome you all to Q4 and FY23 results call of Prudent Corporate Advisory Services. The company is represented by Mr. Sanjay Shah, Chairman and Managing Director, Mr. Shirish Patel, CEO and Whole-Time Director, Mr. Chirag Shah, Whole-Time Director, Mr. Chirag Kothari, Chief Financial Officer, and Mr. Parth Parekh, Investor Relations. I will now hand over the call to Mr. Sanjay Shah for his opening remarks, post which we will open the floor for Q&A. Over to you, sir.
Thank you, Dave. Thank you very much. And I thank you all who have joined the call today for sparing their valuable time. And I hope you all have gotten access to the investor presentation, which has been uploaded on the exchanges. And I wish it is handy with you, because during the discussion, I might give reference to various slides. So now, if I start talking about the fiscal year which has been ended, we crossed very key important milestones in FY23. Number one is our mutual fund vertical revenue has crossed 500 crore for the first time. Then our cash flow from operations has exceeded 100 crore, and actually it ended at 127 crore. And insurance, which is a very important business for us, has crossed 10% in our overall consolidated revenue. So for the stellar performance, I would like to extend my warm thanks and gratitude to our Prudent partners, who are our key pillars to the strength in helping us to achieve these milestones. As you are aware that in case of Prudent, we continue to drive the mutual fund business through our granular systematic investment plans, and our SIP flow in the month of March 2023 stood at 522 crore, which was 27% higher than a year ago. So despite we being a very strong player on the SIP front, we believe there is a much more ground for us to cover. And for that matter, I would like to take you to our slide number 31. So if you look at this slide, of our investor base of 15.3 lakh clients, 50% of our investor base has not even started the SIP yet, as of March 23. So this is a huge base for out of our active investors who have just done lump sum, but they have not done any SIP, or they did not have the ongoing SIP. And I would like to just tell you that if I look at, there is one research which is from CAMS, and CAMS says that CAMS studies about 2.4 crore plus investors, and in the CAMS data also 57% of investors of CAMS has not started SIP. So this data of Prudent also coincides with the CAMS number. So there is a good scope for us to grow our SIP base. Not only this, if you look at out of 7.5 lakh investors who have started SIP, 50% of that, so roughly 3.2 lakh investors, only one SIP. So there also we feel there is a good scope for us to increase the number of SIPs of these investors. In the same slide, I would like to highlight you to look at another data point, which is about number of years experience of investors which they had with Prudent. So when I'm talking about number of experience, what we did is the first transaction which they did with Prudent, from that date till date, they are considering as a relationship they have been enjoyed with the Prudent. So look at the chart on the right hand side. With that, out of our total AUM, 68% of the AUM is of those investors who have done their first transaction before March 2020. Hence, these are the investors who have seen at least one down cycle in their lifespan, and this is a data point which gives us a confidence to increase our wallet share from the existing customers. So as stated, we ended March 23 with a monthly flow of 520 crore, which is almost with almost a second rupee in our gross inflow coming from SIP. Now, I would like you to take a look at the slide number 23, and if you look at the movement in AUM between March 18 to March 23, 52% of our AUM has been contributed by net sales, while the balance 40% is from the mark-to-market gain. So bearing the COVID with years, our net sales number has been equal to or higher than our gross flow from SIP. So we can fairly assume that our net sales will be we can closely track our net sales to our gross SIP numbers. Now, in the same context, if you annualize my monthly SIP flow of 522 crore in the month of March, we expect that our gross flow from SIP would be 6,200 crore in FY24, which is approximately 11% of our FY23 closing AUM. So we are confident of generating 10 to 11% growth from net sales, and we expect that balance 10% can easily accrue from mark to market, enabling us to grow at an annualized rate of 20% over the longer run. And we believe that we can reach the 1 trillion AUM mark in next 3-4 years. Add to this, as you are aware that we have been exploring inorganic opportunity in the industry because of significant cash surplus which we have currently, about 142 crore, and we continuously generate the healthy cash every year. So probably if we are able to identify good acquisition, then this landmark of 1 lakh crore can be achieved in a year also. We continue to be aggressive on diversifying our revenue stream, and on the revenue front, from revenue from other products, which has grew by 114% year on year during FY23, and this year in the distribution basket we also added liquid loan, which is a P2P product, and we also started distributing the small case product on our Fund Bazaar platform. Insurance as a vertical has performed exceptionally well in FY23, with revenue almost doubling. It is now close to about 11% of our overall revenue. Our total premium grew by 78% during FY23, and commission grew at much faster pace due to higher share of remunerative life insurance policies in the face premium. We have around 7,750 mutual fund distributors or their family members working as a point of sales in insurance segment. Insurance, as you all are aware, that Jan-Feb March was a robust and exceptional year because of taxation related changes. Now I'll take you to slide number 46, which talks about our standalone results. So in FY23, our quarterly average AUM grew by about 33%, led by strong SIP flow. And as you all know that in last year we acquired Karvi by about October, November. So the full year average of Karvi came in current year, and that's the reason. Because Karvi was not there in last year's base for about 9-10 months. So because of that, our overall AUM has grown by about 33% on an average. Consequently, revenue also grew by 33%, because as your average AUM grew by 33%, revenue also grew by 33%, and our net revenue yield has remained stable at 95 basis points. Operating profit grew at a faster pace than the revenue growth at 38%, mainly aided by benefit of operating leverage, and margin has expanded by 95 basis points to 22.88%. Our profit after tax grew by 26%, a tad lower than operating profit, mainly because the amount which we paid for acquiring Karvi has been now amortized, and this is the year where full year amortization has came, so the depreciation has reduced our profit after tax up, but tad lower. Our cash flow from operation has been very, very steady and very, very healthy. And from our standalone operation of Prudent Corporate itself, we reached a 100 crore mark. We reached closer to 100 crore, so we ended the year with a 94 crore of cash flow from mutual fund distribution operations. If you look at slide number 41, the good part in this standalone operation is that our opening AUM for FY24 is at 56,189 crore, which is almost 6.4% higher than full year average of last year, which was FY23's full year average was 52,864. And as you all are aware that it's a revenue which is linked to average assets and the trail, and you can easily look at that because the year is starting at 6.5%, the higher in the opening AUM. We also had a good head start, not only on the average AUM, but also, if I'll just tell you about the current number, we already surpassed 60,000 crore AUM, which is about 13 or 14% higher than last year's full year average. So overall, just wanted to communicate that mutual fund vertical has a good head start for FY24. Now look at the slide number 45, which provides our consolidated results. So consolidated revenue from operation in FY23 grew by 35.6%, led by healthy growth in mutual fund vertical as well as excellent performance of our insurance vertical. Operating profit grew by 51% year-on-year to 173 crore, led by benefit of operating leverage coupled with a large share of insurance in the overall revenue composition. Consequently, our profit after tax grew by 45% to 117 crore. Cash flow from operation during the year stood at 122 crore, and our cash flow from operation to net income stood 104%, indicating a healthy cash conversion. So this is all about the FY23. So if I sum up FY23, it was a very great year for us, and we expect that this momentum will continue in FY24 also. There are some headwinds going into FY24, mainly led by SEBI consultation paper on the DB of TER, which has been for the public comment currently. However, we are in the business of volume, and we believe that volume do compensate for the margin compression in absolute basis points, which we may witness going forward, given that we are growing at almost 2 times than the industry on the equity AUM front. So it is all about Prudent performance and the data. I'll now keep the floor open for question and Q&A. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Good morning, sir. Thanks for the opportunity and congrats on good set of numbers. So just want to understand, currently within the SIP book, how is it split between, say, pure equity, hybrid, and solution-oriented funds? And similarly, on the EM also, if you can share similar splits on the equity EM.
Just a moment, sure. Rohan, you can move to next question. I'll just get the data and I think the pass will provide information.
Sure.
If you will just add the question with Concall only. If you can move to another question.
Fine. Sir, second was that there are certain schemes which are of SIP plus SWP nature, and where the SIP flows is for a relatively long period of time. So as a distributor, how do you see, and as an investor also, how do they see this kind of a product? And are we more inclined to do these kind of products because we get a longer tenor of flows on them? Just want to understand your view on this.
So yeah, I think there are SIP, SWP combo product, which is like, say, ICICI has, the SBI has. So we do provide those products on our fund bazaar. We have already onboarded them. And definitely, I think it's a focus as far as, because you are absolutely right, because that gives you not only the longer duration money, but I think it takes care of the retirement requirement of the investors. Definitely, it's a very good product for us to focus on that. Yeah.
Sure. And sir, here also, what would be the share in the SIP book of this product if you share along with the data? Third, sir, in terms of what would be your view on the recent decision paper that has come out from SEBI? How do you read that in terms of the impact on Prudent?
So I think it's very premature for us to say anything as of now, because if you look at the consultation paper, which is open for the public debate, and I think everybody would give their suggestion, and finally what is going to be the actual change which will come from the regulator. So friends, there are a lot of floating points. For example, SEBI has said that the TER should include not only the brokerage but incidental costs like STT also, and which is probably very difficult for somebody to project, right? Because I don't know which particular fund has what kind of churning. So I think that cost is very, very floating, and that is one point which probably keeping everybody on tenterhook, that how should they come to a conclusion of what is the actual impact because of revised TER. So there are important point I just wanted to communicate that the standalone, if you do not look at the inclusion of probably brokerage and GST in the revised TR is reasonably compensating the overall structure of the AMC at an individual level. But what is hurting is probably inclusion of brokerage and STT and definitely GST also. And so overall probably I think how industry will react, how much they'll pass on to everybody in the entire value chain, what are their views on passing to a retail IFA as well as to us. There are a lot of things which will remain floating for us to come to a real conclusion that what's going to be the impact. But I can tell you the positive part of this would be that as industry become more and more competitive, the need for people to align their interests with a larger platform, quality platform would become very, very important. And that's we feel that it's going to be a important thing for us over a period of time.
Sure, sir.
And Rohan, in the SIP book, we have 93% in equity and 6% in hybrid. Yeah.
Sorry, sir. I missed the number. 93% is equity and 7 is hybrid.
3%. Yeah, 7% is hybrid. Yeah. 6% is hybrid. 1% less than 1% is probably debt or solution-oriented fund kind of a thing.
Okay. And sir, what was the mix of this SIP plus SW systematic transfer fund kind of thing?
Mr. Mandora, I would request you to kindly repeat because we did not understand what you spoke just now.
Yeah, sorry, sir, on that SIP plus SWP, how much that would be within the SIP book?
So SIP, SWP, that I think separate number नहीं होगा मेरे पास ICICI, Freedom, SBI, Mitra, so all of the number नहीं होगा. I mean, probably we can get the number and we'll communicate to you.
Sure,
but
sure.
Get significantly large.
Sure, sure. Okay, thank you.
Normally, it is the vanilla product which is sold very, very significantly. But it's a good product for us to do. And people have been doing a lot of efforts. But if you look at the number, I think that number is not handy as of now.
Fine, sir, fine. Okay, thank you.
Thank you. We have the next question from the line of Ashwani Kumar Agarwalla from Edelweiss Mutual Fund. Please go ahead.
Good morning, sir. So as you said that the margins may take a hit because of the new TER regulations. So you must be in talks with various mutual funds. So what is the glide path the mutual funds are given to you in terms of the brokerage revenue or the commission revenue which you get in terms of percentage?
I want Shirish to address it. Shirish?
Yeah. So basically, we already spoken to multiple AMCs. As of now, we believe that most of the AMCs are still actually calculating the total impact on the various schemes. None of the AMCs have yet decided, or rather I would say that they are not yet clear that what would be the exact impact on every scheme and what would be the pass on to the distribution and to the other stakeholders. So you being from one of the AMC as well, I think when we spoke to your AMC also, we could not get the accurate answer. We believe that still it would take some more time to get clarity from the AMC, not just to the industry, that what will be the cut share between various stakeholders. So it's very, very early for us to comment.
Okay. We have seen the TER cut in the last two instances in 2014, 2018. So how much of that TER cut was passed on to us and across various mutual funds? Do larger mutual funds pass on the more or smaller mutual funds pass on more? Or where we have bargaining power?
If you look at the last two TER cuts, majority of the AMCs are passed on full. Specifically, the bigger ones are passed on the full TER cut to the distributors. Smaller AMCs, yes, I think they did not pass on 100%. But if you look at in totality, probably the pass on was almost 95%. This year, this time the situation will be little different. So I think taking the reference from the past that in history the AMCs are passed on 100% to the distributor, will they be able to pass on 100% this time? I think the only time would say that it is a questionable thing right now because the impact on the TER is not only and only because of the SEBI's new TER structures, because now the brokerage and the GST and every part are included.
So, frankly, it's too early for us to tell, but yeah, historically, I think more than 95% of the TR was passed on to the distributor. But we strongly believe that this time it would not be the case.
Okay, sir. That's from my side. Thank you.
Thank you. The next question is from the line of Lalit Deo from Equirus Securities. Please go ahead.
Yeah, hi, sir. Good morning. Thank you for the opportunity, and congratulations on a good set of numbers. So, sir, first question was on the data which you have provided on the AUM front.
Sorry
So,
Mr. Deo, we would request you to kindly use your handset, please. Your voice is muffled, sir.
hello, is it better?
Please continue. Thank you.
Yeah. So, I was asking, sir, in this AUM bucketing which we have given, so that data shows that about 40% of the AUM comes before April 2017. So is it the AUM or is it just the investors who have been associated with Prudent prior to April 2017?
So so what we did is that your AUM might be recent, but we looked at whether what was the relationship of that customer with the Prudent. So you are right. Let us assume, for example, I would have invested out of my 1 crore portfolio, 90 lakhs would have been invested in the probably last 2 years, but my first transaction might go back to probably 2015, 2016. So just wanted to communicate that 67% of the AUM which we have today, these are the people who started relationship with Prudent before COVID period, and they would have seen at least 1 or 2 cycles. So these are the mature investors. Just wanted to communicate that 67% of the AUM belong to those people who are reasonably mature and they have seen the volatility. That was the message.
Sure. And sir, secondly, on the insurance piece, so right now, this quarter, we have seen a strong growth. So currently, what will be the mix between the origination between the in-house employees and the POSPs model, and how do we see it increasing over the next 2-3 years?
Suresh, Chirag Kumar, anybody want to read it?
So if you look at historically, the majority of the business used to come from 3 channels of ours, that is the online, our wealth channel, and our direct channel. POSP, as we said in the prior calls also, that POSP was a new channel introduced before a few years, and incidentally, the contribution is coming from the POSP channel very, very high. So if you look at every quarter, the contribution of the POSP channel is increasing, and the last year, whatever growth we have seen, of course, one is because of the taxation change in the industry, but at the same time, the POSP contribution to our total overall business is also increasing rapidly. As I said, that currently almost 7,500 plus POSPs are now registered with us, and more POSPs are getting active nowadays. Roughly, if you can see last year, the business contributed by POSPs almost 50% in the last quarter to be precise, I would say.
So just wanted to check, last, the number which you quoted was, hello?
Sorry, I couldn't hear you. Hello?
So, sorry, sir, your voice got muffled in the last part of the answer. So, could you repeat that, please?
I said that the POSP contribution in the insurance business is increasing quarter and quarter. Specifically, last quarter, when we did the highest year business, the business contribution is mainly because of the 2 parts, I would say. One is the taxation changes, and secondly, the POSP contribution in the last quarter has increased. So in the insurance business, last quarter, POSP contribution towards the business will be around 50%.
Sure, sir. And so and the last question was on this TER regulation. So hypothetically, if there is some passing also which is done to us and all the other distributors, so then what will be our intent in passing on these TER cuts to our channel partners? So how do we see in this whole scenario panning out for us in terms of net yields?
So if you look at the historically, I think 2 TER cuts, we could pass on majority, or rather I would say that almost everything that was cut by AMCs for us. Because there are 2 parts that are very, very important for us to decide and how much we will be able to pass it on to our distributors. One is, of course, how much AMCs are cutting to us, and second, very important parameter is that how much AMCs are cutting to their IFAs. Because we also, I think you can see indirectly, we also cater to the IFA segment of the industry. So two important variables will decide that how much we will be able to pass it on for these forthcoming TDR cuts. But historical reference, if you want to look at, I think I would say that we could pass on almost everything what was cut by NCT.
Sure, sir. Sure, sir. Thank you, sir. That's helpful.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi sir. Congrats on the set of numbers. Firstly, just continuing on this new TR regulations, whatever we've done suggests that the smaller AMCs are actually benefiting out of this move, and they might have some room to kind of distribute better or give better commissions to distributors. So in that kind of a scenario where the larger ones will market kind of that they are the lowest cost ones. On the other hand, you will have distributors kind of wanting to sell more of the smaller ones where commissions will be better. How would this kind of eventually in your sense how will this kind of play out for the industry?
Yes, it is. So today also, if you look at, there is a gap between TR, I would say the bigger schemes or bigger AMCs, the TR are always lower than the smaller AMCs TR, schemes TR, I would say. If TR cut or TR is the only, I would say, information which investors are looking at, then probably would not be any buyer for the smaller schemes. But if you see last few years, the smaller AMC's market share incrementally is increasing in the industry. Now, obviously, there are multiple factors affecting why smaller AMC's market share is increasing in the industry. So one, definitely the performance consistency. Obviously, I think few of the AMCs have shown the performance track record now. Secondly, also always actually I would say that mutual fund to certain extent fills up this product, and distributors play a very, very critical role in selecting the funds. So obviously because of that also you would have seen that the smaller AMCs market share is increasing. Yes, as you said that bigger AMCs will try to communicate their expenses is lower, and the smaller AMCs will try to go to the distributor saying that the commissions are higher. Distributors also don't go only by way of commission. So obviously, I think there is a merit in the smaller schemes also, a smaller AMC also. There would be a merit in the bigger AMC, the bigger schemes also. So the distributor, we also try to give the balancing to approach the clients. Based on the client's requirement, definitely we will offer the products to the client. Simply, we will not go with the lower TER or the higher commission. So obviously, the way distributors are functioning till now, I'm sure I think they will continue to function in the similar way going forward as well.
Okay. And so, do you think that this move that has happened, which may eventually turn out to be into regulations, will that expedite your conversion of existing distributors to insurance distributors as well, and scale up the non-MF business at a much faster pace within your set of partners?
First question I couldn't understand, the first part of your question.
So basically what I'm asking is, will this move that turns out into the regulation later to kind of expedite or fasten the process of converting your just MF distributors into more insurance distributors and also some other products that can help you scale up the non-MF distribution business?
Yeah, obviously, I think I'll give answer in two parts. One, obviously, as you say that for the existing distributor, because of the TER cut would help to penetrate more into the non-mutual fund products. Yeah, whenever the revenue is reduced in any product, distributors might look at other products more seriously to compensate the loss in one particular product. The same would apply to us also. Yes, I think because of the revenue cut to the distributors going forward, they always be trying to find out additional product wherein they can compensate so that they can increase the wallet share from the client. To certain extent, yes, there could be some little shift from MF to the other products. Having said that, whether the focus on mutual fund distribution business will go down from Prudent the distribution ones, I think probably the answer would definitely be no. But yes, the market share or the share of revenue from other products would definitely increase. But still, I would like to add one more point here. Because of the TER cut, as I said, the mutual fund revenue for our distributors will come down. So the distributor community who are not associated currently with the platforms like us, obviously would like to go to the platforms to get the multiple products at a single place, as well as they would like to reduce their operating costs. So those distributors or those IFAs or NFDs still currently not dealing with the platforms might look at platforms to compensate the shortfall in the revenue. So I think that way we believe that more and more NFDs will move to the platforms to offer multiple products. So that is the additional point I would like to highlight.
Yeah, that's very helpful. Thank you so much.
Thank you. We have the next question from the line of Srinath V from Bellwether Capital. Please go ahead.
Hi, sir. Wanted to understand, so the top 3 asset management companies with over 10% market share, they put out their disclosures on payouts. And if you see the payouts for all of them are far exceeding, equity asset growth. For one of the asset management companies, it's significantly higher than equity asset growth. So is it fair to assume that the front book or the new flows, payouts have drastically gone up? Could you, in our book, kind of tell us for the new assets we originated this year, what would be a payout or what would be our revenue versus what it was last year from a yield perspective? Because we'll be getting a blended yield, but if you can disaggregate it and help us understand, and also want to understand what drove, is it platforms like us who have been able to aggregate and bargain and get that significantly higher, payouts from these large asset management companies?
So, giving answer to your first question, of the last few years, you have seen that the share of commission in the AMC is much higher than the equity AUM growth. One main reason I would say that historically, when the transactions or every transaction distributors used to get the trade commission, the trade commissions were lower. Last few years, specifically after 2019, everything has moved to the trade. So obviously, the investments of the transactions are moving on the trade commissions are higher. So in the AUM mix of any distributor or any AMC for that matter, there were assets, the prior assets of 2019, which were at a lower trade. So 2019 and 2023, I think 4 years, much of these assets would have been churned. If you look at the if you look at the industry, the average life of any equity is around 3.5 years. It is safely we can assume that majority of the assets which belong to 2019, I would say that by now it would have been churned. So incrementally, we don't see there will be a huge difference between the equity AUM growth and the commission payout growth for the AMC. So, which is the first point. Second point, I will say that you asked the bargaining point. Yes, I think always it happens that higher the business, the bargaining power improves. But in past also we have already communicated that now going forward, I think we don't see a great improvement in the bargaining power with the agencies because we believe that we have touched that particular ceiling. So incrementally bargaining power from the AMCs probably we might not be able to enjoy. I think we'll be able to maintain that currently we are. But again, I would say that, as you said, the AMC's commission share is increasing compared to the equity AUM growth. I believe that going forward, that should not be the case.
So for us, I wanted to understand, would the assets originated in the current financial year have a higher yield than assets originated in the last financial year? Is that a fair assumption to make? Or, after 2019 or this year, last year, were all the similar payouts, only the, prior book has that kind of lower payouts?
So if you simply are asking or comparing the average yield on the transactions of 2022-23 and 21-22,
yes, sir.
Everyone, including every distributor, I would say that 20-23 transactions will have faced lower yield compared to 21-22. Everyone, because when the AMC, as I think as you understand the TR, current TRCS of the AMCs, as and when the AUM increases, by default the commission payout decreases. So today AMCs are maintaining whatever percentage share to the various channels. The percentage remains static. So when the TER goes down for the AMC, obviously the net yield or the gross yield to the distributors also comes down. So if you are simply comparing 21-22 and 22-23, the 22-23 yield would be lower than 21-22.
But that's where I'm very confused, because if you look, like I said, couple of AMCs, you look at the numbers, they're actually at payout growth of 40% YOY. And asset growth will be 15, 16, 17%.
That is the reason I am saying, because of the historical asset churning. So when you are simply asking the new transactions of 21, 22 and 22, 23, which will be the case, what I am saying.
Got it. And in the backdrop of last 2 years of commission payouts growing, and especially this year growing significantly faster than asset growth, do you see the larger AMCs coming down and saying that, we want a full pass-through of whatever cuts we are taking, given that they have had very enhanced payouts over the last 18 months? In that context, do you feel it will be very difficult for us to push back saying, you guys have to take 30-40% of the hit, we'll take 60%? Now, how is this whole thing going to transpire, especially in the context that they've all had 40-50% payout growth for FY23?
Yes, I couldn't hear it completely, but what my point is, historically 2018 and 2019, both the TR cut, majority of the AMCs have cut 100% of the TR to the industry, almost 100%, I would say. This time, as I said some time back, I think the scenario may be different. AMCs might not be able to pass on the 100% cut to the distributors. As I said, I think it's too early for us to comment on, because none of the AMCs are made their stand clear. It will take a little more time for us to understand what AMCs are thinking.
Okay, and whatever cuts we get, we will pass on 100% of that down, or we would be taking some proportional hit on our unit economics? How will it work for us now, as a platform?
I think that depends on what AMCs are doing for the MFD registering or doing business with them directly. If AMCs is treating everyone the same, obviously we also have to treat our distributors the same. So as I said, it is not a standalone decision right now. That again depends on how AMCs are cutting the TR or the passing on the TR cuts to their MFDs. So that only we can also comment only when we know AMCs stand for their distributors or their MFDs and us. So as of now, it's for us. I think giving any indicative number that what percentage will be able to pass it on, I think it's too early.
Thank you, sir. It was absolutely very informative. Thanks for taking time and clarifying everything very patiently. I'll get back into the questions.
Thank you. Ladies and gentlemen, a request to all the participants, kindly pick up your handset while asking a question, as this is required to ensure optimum audio quality on the call. Thank you. The next question is from the line of Varshap Shah from Envision Capital. Please go ahead.
Yes, sir. Thank you for taking my question. If we see the commission and fee expense as percentage of revenue, that has fallen significantly this year, like almost 3 percentage points. Has there been any change in our sharing with MFDs, or is it, or has the mix changed, like are we selling more direct from our own employees?
Sorry, I think probably for the purpose of commission, you should look at the standalone number of mutual fund distribution business, wherein the growth in commission payout and the growth in top line is more or less in line with that. So giving answer to your question, is there any change in payout metrics? No, it has been steady, absolutely rock steady. I think the profitability mix would have improved mainly because of insurance vertical, where a lot of business comes from DQPs and the direct business. The profitability has been very, very strong.
Okay, sir. Thank you. Thank you for taking the question.
Thank you. The next question is from the line of Ashutosh Garud from Ambit PMS. Please go ahead.
Hello.
Yes.
Yeah. So
I'm sorry, sir. Your voice is breaking. Can you please use your handset?
Yeah, I'm on the handset. Am I audible now?
No, but your audio is not clear. It's breaking.
Yes. Is it better?
Yes, sir. Please continue.
Yeah. So in the initial You mentioned about the contribution to Karvi position for this particular quarter. Can you quantify what kind of a top line and bottom line got contributed from that particular business in this quarter compared to the previous one?
So, Karvi, we do not report the separate number because virtually if you look at the asset of Karvi, partners who became Prudent partners, so assets also got merged with their existing AUM with Prudent as well as their AUM which came from Karvi. However, in the first 3 months, when we acquired, we analyzed the earning from Karvi, which was close to about 2.5 crore a month. And if I look at last 12 months, there has not been any slippage from the Karvi assets. So I think Karvi would have contributed close to about 20-25 crore in our 25-30 crore kind of bottom line. Profit before tax would have been contributed by them at the gross profit level. So I think when we acquired, when we did the calculation of payback period, which was close to about 5 years, I think probably it remains the same.
Would we have any
Pardon?
Mr. Karud, I would request you kindly repeat your question as your audio is breaking, sir. I'm sorry, sir, we are not able to hear you. I would request you to kindly rejoin the queue.
Sorry.
No problem. Thank you, sir. The next question is from the line of Ajox Frederick from Sundaram Mutual Fund. Please go ahead.
Hello, sir. Congrats on a good set of numbers. Sir, my question is on the insurance side, where we did see a strong inflow for the quarter. So what proportion of this is because of the one-time tax benefit out of this 105 crores?
Suresh?
That's a good question completely, but I think I understand that what percentage of the business is contributed because of the one-time gain of the taxation.
Exactly.
So that is the case. Roughly, I would say that last year's life insurance business, almost you can say around 18 to 20% kind of business would have been contributed because of that one-time gain of the taxation. So there was a pre-payment of the buying. Roughly, you can say 18 to 20% kind of numbers would have been contributed because of this taxation change.
Okay, that is helpful, sir. The second question is on the distribution again, insurance. 50% is coming from POSP, right? So what is our take rate? So how does the model work in POSP?
So as I said, incrementally month-on-month, quarter-on-quarter, the share of POSP is increasing, and as we communicated in earlier calls, that we believe that next growth of our business also should start coming in from the POSP. So take rate, I think the percentage sharing again depends on the product to product, but average you can say around the similar way to what we do in the mutual fund side. 2/3, 1/3 is the kind of average number we normally plan to.
I'm just trying to understand, is it very much different from the other distribution channels like a bank or online channel through PSP?
Bank definitely would not, again, I think you are talking about the sharing with the POSP.
Yeah, correct.
Banks would not be doing any kind of sharing with their POSP because banks is a B2C model. We are a B2B model. So obviously, we have to pass it on to our POSP.
Okay. Got it, sir. All right, thanks. That's it from me.
Thank you. We have the next question from the line of Nilesh Jethani from BOI Mutual Fund. Please go ahead.
Hi, thanks for the opportunity and congrats for the great set of numbers. My first question would be, can you help me understand what would be our share of AUM from top 5 mutual funds?
So, 5 mutual funds in specific currently, I'll just share the number. You can say almost, I don't have the exact number right now, so the number could be a little different, but yeah, almost you can say 55% kind of number would be top 5 AMC's contribution. But this will not be the accurate number, so I don't have that number ready.
No problem.
It's 50%, 50. Serious. Top 5 MC contribute 50% of the AUM. Yeah.
My second question would be on the redemption. So for last 2 quarters, can you help me understand how has the redemption trend going up? Because in Q4, it seems like we were able to arrest it and net flow seemed to be a little better. So can you help me understand how are the redemptions currently for Prudent and how you expect this trajectory going forward?
If you look at the Q4 redemptions, were definitely lower than what it was in Q3. Currently, if you look at our run rate, which we talk about, which is somewhere in between of Q3 to Q4. So, but we won't say that it's similar like Q4, but we won't say that it is as bad as Q3. So you can say somewhere in between of Q3 and Q4 kind of sentiment on the redemption from the target.
Got it. And the third piece of the question was on the SIP. So today with 510 or 520 odd monthly SIP book, just wanted to understand if I see one interesting slide which you have given on page 32, where no live SIP for approximately 50% of your investors. So wanted to understand from the current bucket of investors we have at Prudent, can we improve this number? And what growth do you anticipate in this SIP book per month inching up to over the course of FY24?
So as far as the number is concerned, then sir, he can continue.
Yeah.
You can continue, sir. I just wanted to say that the number which we took is about there are 50% people who have no SIP. That number I again explain. I just wanted to explain you that these are the number in line with the industry number also. So just wanted to say that we really represent truly retail of the industry. So CAM's number also says that 57% out of the 2.4 crore investor has no SIP. Same is the case with Prudent also. Out of 15.5 lakh customers, almost 50% has no SIP. So definitely there is a scope for us to improve, and that's the reason we have given this data. Another 50% who has already SIP with us, out of that 50% people has only one SIP. So there also we can definitely do a lot of efforts. So now I'll probably just tell Shirish to take it forward.
Yeah. So if you look at, we asked that what kind of numbers we are looking at to add in the SIP numbers. If you see our last 2-3 years trajectory, I think on an average we are adding around 100 to 120 crores of net SIP input value. That is addition in last few years. I would say that net addition is always sentiment driven. I think for good years addition is higher, for bad years addition will be lower also. Before few years the industry used to be negative in keep net addition. Currently, if you look at the kind of run rate, what we are seeing, what is the trend we are seeing last couple of months, I think there is no reason to believe that we should not do better than what we did in the previous year, the addition, in terms of addition. Rather, I think the kind of acceptability what we are seeing for SIP, the kind of interest what the investors have for SIP, and the kind of media campaign what we have, as an industry, everybody is doing, we believe that incrementally SIP flows should increase. So definitely would like to add much higher than what we did in last few years. But yeah, as I said, finally it is still a sentiment-driven number.
Got it. So I asked this question because when I see our MFD addition, it has slightly slowed down in FY23 versus what hyper growth we saw in FY22. So it was always a thought process that Prudent with higher MFD growth will drive a higher SIP book number. So any color on that? Where are you seeing MFD, and also what are the number of active MFD today versus this 23,000 odd number of total MFDs?
So as you said that 22-23 we have added lesser MFDs compared to 21-22. One reason is Carvey acquisition. Almost 1,200 plus distributors we added because of the Carvey merger in 21-22. So that is one time in what we had in 21-22. Second is MFDs addition is also, I would say, when the market returns are better, more and more people would be interested to join the industry. Because new MFDs coming to the industry also depends on the historical returns of the mutual fund. So yes, I think it has little bit slowed down in this financial year, that is 22-23. The point what you said that SIP growth should be linked to the new distributor MFD addition at Prudent, and I think probably I do not fully agree on this particular part. The SIP addition may be contributed by multiple factors, one being the new addition of distributors. But additionally, I would say that Prudent has added almost 50% of the MFDs in last 2.5 years. So obviously, as you would agree that when any person starts the business, initially his growth rate might not be that much. Once he settles down, once he understands the product systems and everything, the growth rate actually comes. So here we would definitely say, I would say that our growth should come from three set of distributors, I would say. Whatever we have recruited or those who are dealing or working with us for last 3 to 5 years or more than that, I think now they are rock stable. I think their flow, their contribution, their productivity is increasing solidly. The much growth definitely would come from those people whom we recruited in last 2.5 years. So that growth is also enormous. And our focus for adding new distributors is not less. So, definitely we are out in the market very, very aggressively to add more and more distributors. So obviously our growth should come from that side as well. Sanjay has shown you the numbers in our of the slide that our share, Prudent share in SIP numbers is increasing year on year, and definitely we would love to see that we keep on increasing our share on the in the industry.
Okay. And one last question from my side. You said you passed the initial comment that you said that as of now there has been 14% growth in AUM versus the FY23 average. Out of this 14%, what you would attribute to M2M and what to the net flows?
So the current year, if you look at the growth which has came, I think the net sales has been reasonably okay. Nothing has changed significantly. However, mark-to-market gain has been significant. So as you are aware that we ended the year at 56,700 crore roughly in March, and today we have crossed 60,000 crore. So the additional, the mark-to-market growth has been very, very robust in these 2 months. So just wanted to communicate that जो साल की शुरुआत है, we are already having a positive opening balance of 100 so our opening balance is 106 rupees versus last full year average of 100. So that was already inbuilt into the opening balance, and then from opening to current we are again up by about roughly about 7-8%, 10%. So I think that put together we are saying that the mutual fund is starting with a healthy base of about 14% positive.
Got it, sir. Got it. That was really helpful, and thank you so much for all the answers and all the best.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. Ladies and gentlemen, as there are no further questions from the participants, I would now like to hand the conference over to Mr. Sanjay Shah, Managing Director, Prudent Corporate Advisory Services Limited, for closing comments. Over to you, sir.
Thank you everybody for joining this call, and we wish that FY23-24 also turns out to be a very good year for us based on the strong tailwind, and thank you everybody for joining. Thank you.
Thank you very much, sir. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.